Hi friends, this is the generation of technology. So we at Iyer Commerce Classes decided, why not use technology for the sake of studies, for the benefit of students. So we have compiled all the critical points, the basics of every chapter, rather the most important chapters at one place in the form of a mobile app, which you can listen to it whenever you want, at your convenience, without requiring Wi-Fi, no internet required, no 3G, no 4G. You just have to download in your mobile and listen to it at your convenience. My advice, listen to all the chapters at least thrice a day till your day of the exam, and I'm definitely sure you'll be able to remember all the critical points during the examination. So friends, take this mobile app, use it and score maximum marks in your examination. Wish you all the best. Our next chapter is accounting ratio. Accounting ratios indicate the relationship between two or more items of financial statements. All the ratios are divided into three parts: revenue statement ratios, balance sheet ratios, and combined and other ratios. Let us start with revenue statement ratios. First one, gross profit ratio. The formula is gross profit upon net sales into 100. Second, operating ratio. Cost of goods sold plus operating expenses upon net sales into 100. Cost of goods sold plus operating expenses upon net sales into 100. Expenses ratio. Number 1. This is called cost of goods sold ratio. Formula will be cost of goods sold upon net sales into 100. Administrative expenses ratio. Administrative expenses upon net sales into 100. Selling and distribution expenses ratio. Selling and distribution expenses upon net sales into 100. Finance expenses ratio. Finance expenses upon net sales into 100. Net profit ratio, three formulas. Operating net profit upon net sales into 100. Net profit before tax upon net sales into 100. Net profit after tax upon net sales into 100. Stock turnover ratio, formula will be cost of goods sold upon average stock equal to number of times. Cost of goods sold upon average stock equal to number of times. Average stock will be given by opening stock plus closing stock upon 2. These were the 5 revenue statement ratios. Let us go to balance sheet ratios now. First one, current ratio, also known as working capital ratio. Formula is very easy. Current assets upon current liabilities. The standard ratio is 2:1. More than that, favorable. Lower than that, unfavorable. Second, quick ratio, liquid ratio, acid test ratio. Formula, quick assets upon quick liabilities. The standard ratio is 1:1. Above that, favorable. Below 1:1, unfavorable. Proprietary ratio, shareholders' funds upon total assets into 100. Total assets is given by fixed assets plus investments plus current assets. I repeat, total assets equal to fixed assets plus investments plus current assets. The standard ratio is between 60% and 75%. Stock working capital ratio, closing stock upon working capital into 100. Capital gearing ratio, formula, preference share capital plus loan funds upon equity share capital plus reserves minus fictitious assets. Preference share capital plus loan funds upon equity share capital plus reserves minus fictitious assets. Last one, debt equity ratio, formula, loan funds upon shareholders funds. Loan funds upon shareholders' funds. Let us go to the other ratios now. First one, return on capital employed, also known as return on investment. Formula, net profit before tax plus interest paid upon capital employed into 100. Net profit before tax plus interest paid upon capital employed into 100. Interest paid you will get from finance expenses. Capital employed formula is shareholders funds plus loan funds. Return on proprietors funds formula, net profit after tax upon shareholders funds into 100. Net profit after tax upon shareholders funds into 100. Return on equity capital formula, net profit after tax minus preference dividend upon equity share capital into 100. Net profit after tax minus preference dividend upon equity share capital into 100. Earning per share, net profit after tax minus preference dividend upon number of equity shares, and the answer will be in rupees. Net profit after tax minus preference dividend upon number of equity shares equal to rupees. Dividend payout ratio, total equity dividend upon net profit after tax minus preference dividend. Total equity dividend upon net profit after tax minus preference dividend. Debtors turnover ratio, credit sales upon debtors plus bills receivable equal to number of times. Credit sales upon debtors plus bills receivable equal to number of times. An average collection period will be given by 365 or 52 or 12 upon debtors turnover. You will get the answer in days or weeks or months as the case may be. Note, if opening debtors and opening bills receivable is given in the problem, then you will take average debtors and average bills receivable for the above ratio. Next, creditors turnover ratio formula, credit purchase upon creditors plus bills payable. Credit purchase upon creditors plus bills payable equal to number of times, and average payment period will be given by 365, 52 or 12 upon creditors turnover. You will get the answer in days or weeks or months as the case may be. If opening creditors and opening bills payable is given in the problem, then take average creditors and average bills payable for the above ratio. And last, debt service ratio. Net profit before tax plus interest paid upon interest paid equal to number of times. Net profit before tax plus interest paid from finance expenses upon interest paid equal to number of times. Thank you.